More than 8,000 retail stores closed their doors in 2025. Wall Street says we ain't seen nothing yet. They're even predicting 40 to 50,000 store closures over the next 5 years. We're going to jump in that today. Okay, and we're back, Scrushy on Business. I'm Richard Scrushy, and we got a lot to talk about. Like I said in the opening, more than 8,000 chain retail stores closed their doors in 2025. I mean, that's incredible. 8,000, companies like Rite Aid, names that you grew up with, Party City, names that we all know, they're gone, and more are going. And the experts now on Wall Street are saying we haven't seen anything yet. They're predicting 40 to 50,000 store closures over the next 5 years. Just this year, Saks Fifth Avenue parent company filed for bankruptcies. Macy's announced another round of store closing. Francisca's about 400 stores closing, every single one of them. Walgreens is shutting down. Get this, 1,200 locations. I personally use Walgreens. I use CVS sometimes, but I use Walgreens a lot because it's convenient. It's right down the street from our house. But yet, 1,200 stores are closing. Wow. Walmart briefly crossed this past year $1 trillion in market value. $1 trillion in market value. Of course, Amazon is carrying the entire retail sector's earnings growth on its back. And Target just beat Wall Street's expectations and raised its outlook for a year. So why is that? Why are so many stores closing? Why are so many retail stores going out of business? But yet we've got Target coming back. We've got Walmart with incredible, value. We've got companies like Amazon continuing to grow. So what's the difference? What's causing this? Good question. We're in the the economy is not really changed that much. We got the same number of consumers. We've got the same inflation. We do have some tariffs, of course, but why are some retailers dying and others are thriving? Good question. What is the answer? Let's talk about that today in this episode. Whether you run a retail business or a software company or a medical clinic, there are lessons here. There's lessons that can be applied. Take a break right here. Put me back on, Brandon. There are lessons, as I said, that can be applied here. So, stay with me on this. And, I've spent my entire career building businesses, scaling businesses, and watching many businesses fail. I've seen that. Sometimes I've been very close to them. I've served on some boards that, companies didn't do so well. I left a board one time, and the company, I served on it for several years. It was doing fine, and then I was ready to move on because it was just taking up too much of my time. And then a few years later, they filed bankruptcy. They went out of business and ended up selling off all their assets. But while I was there, they seemed to be doing good. So there are lessons in all of this, and we need to kind of do an autopsy on this and look at it. What is happening here? I learned a long time ago that most companies never die from just one bad quarter. You're not going to die from one bad quarter. It's going to take more than that. It's going to take multiple quarters. It's going to take time, and it's just not going to happen, in a short period of time. It may take a year. It may take 2 years or 3 years before companies actually go away or die. And so let's take a look at some of the survivors and why, and let's look at some of the numbers and try to help tell the story as to what happened. In 2025, over 8,000, chain retail stores closed in the country. And, what caused that? We saw a lot of bankruptcies. They kept coming and coming, a lot of bankruptcies. By mid-December of 2025, corporate bankruptcies were running way ahead of 2024. So 25 was not a good year. And then 2026 kind of opened with a bang. In just a few weeks, we had Saks Global, the parent of Saks Fifth Avenue, Neiman Marcus, and Bergdorf Goodman, all filed Chapter 11. Macy's announced 14 more store closures, and on top of a plan to shut roughly 100 and 150 underperforming stores by the end of this year. QVC, the home shopping giant, filed Chapter 11 to restructure a $6.6 billion in debt. $6.6 billion in debt. They had to restructure that. So, let's talk about things that kill companies. There are basically 5 things I want to discuss today that cause retailers to die. And let's get into the why. Okay, the number one killer is debt. Debt kills more companies than competition ever will. You overdo the debt and you're going to go out of business. So see, when you're building the debt on a company, and you've got a certain cash flow, you don't want that debt. And that cash flow softens, revenue softens, sales soften. Now you got this debt issue, and you're upside down, and it begins to put you out of business. So, you've got to be very, very careful with that. So, in looking at Saks Fifth Avenue, they created a company that was carrying over $2 billion in debt. So as luxury spending slowed down because, that's what that company was all about. It was a high end. People, there are a lot of people, they buy their clothes at Walmart and in Target, and there are a lot of folks that, live high on the hog. They're up and make the money. They're up there buying their things from Saks Fifth Avenue. So as luxury spending slowed down, they missed an interest payment. Okay, and that entered into a grace period, and then they ended up filing for bankruptcy, and it just did not have the cash flow to be able to support the leverage that they had put on the company. So when you look at it, leverage is really a loaded gun. Now, so as you leverage it up, you're putting a gun to your head, because if something happens and your revenue and your sales soften, you're going to go under. So here's a statistic that maybe everyone should pay attention. In early 2024, 70% of large U.S. corporate bankruptcies involved companies that were owned by private equity. Now, just think through that. Private equity had put a lot of money. Now, that's 70% of large U.S. corporations that were owned by private equity, 70%. So when you load a business up with debt to finance its acquisition, you've removed its margin for error. See, so if you don't have any debt, you can have a slower sales, but you continue to rebuild and keep going. But when you have too much debt and it goes down, you really put yourself in a bind. And again, like I said, you put that gun to your head. The leverage is a loaded gun. That's what we're saying. So as we look at bankruptcies in 2024, 70% again of the companies were backed by private equity. So, and apparently, many of them had loaded those companies up with debt. So, if you have a really bad year and you don't have any way to overcome that, and you've got too much debt, it could be the one that would kill you. The number two killer of retail companies is overexpansion. So you got debt and you got overexpansion. Okay. For 30 years, retail growth meant one thing: open more stores, open more. I built a company and we had over 2,000 locations. But you know what? We didn't overdo the debt, and we were able to raise equity as a private company. As the stock continued to go up, we were able to raise equity. We were able to get bond debt that was at very low, 1 over LIBOR, 1.25 over LIBOR. So we were, under prime and very cost-effective debt. And when you looked at our debt to EBITDA, it was very, very healthy. So we were able to do quite well. But number two, overexpansion. So keep in mind that every store has fixed costs. You got rent, or you got the cost of the bricks and mortar. You got energy costs, utilities. You got people. You got insurance. So you got leases. You've got inventory in those facilities that you got to carry the cost on. So when customers left those bricks and mortar stores and went online to buy their products, okay, those stores, that were out there, they're big anchors, big expensive anchors with all that fixed cost, and that drove. When you take it online, when you quit buying your clothes at Macy's and you start buying them online, and you're not going to the bricks and mortar and you buy it from some of the discount places online, and we're looking at so many different things that are being bought. Right now, even Amazon is selling pretty much everything except for the drugs that you buy at Walgreens. You can get cough syrup. You can buy, pretty much everything. All of the beauty products and hair products and facial products and vitamins and everything they sell in there. You can just buy it on Amazon. I'm amazed. Everything from tires for your car to, tail lights. If one of them goes out to engine parts or your car. I mean, you can buy pretty much anything you want. All items, they're just there, and so it's those are things that were bought at stores that were bricks and mortar stores, and so all that business is going away, and the question is, where's that going to end up? So overexpansion. Companies that build all of these bricks and mortars, and now the stuff going online, so their revenues are down. They got the fixed cost with all of it, and so when that fixed cost is higher than the sales, so you got the fixed cost, you got sales down here, it's going to end up in some kind of bankruptcy, and things are going to change. So that's number 2, overexpansion. Killer number 3. If you're getting stuck in the middle. I talked a few weeks ago, we talked about the fact that you got to have something 10 times better than your competition to get the people to come to you and not go to the competition. So, and this is kind of the same thing. If you're stuck in the middle, in other words, there are people that offer some kind of special thing and they're up here at the top and they've got the customers coming. And then there are people down here that offer things, but they've got it at such a low cost that they're driving people in to buy it there because it's cheaper, it's less expensive. And if you get caught in the middle, that's where you really get hurt, is when you get caught in the middle. That's what takes you down, and you just have to be careful about being caught in the middle. So number 3 is getting stuck in the middle. Let me give you an example of what I'm talking about. Dollar General and Aldi are among the biggest store openers in 2026. They're definitely not true. They're not luxury, and with stores with healthy balance sheets. It's the middle. Retailers that weren't the cheapest, weren't the fastest, weren't the most fun, and weren't the most premium. Okay, if a customer can't finish this sentence, I stop there because of what? I stop there because their product is 10 times better than any over here. That's like I told you, I go to a restaurant with my wife because they have something at that restaurant 10 times better than any of the other restaurants, and we go there just for that. And it drives us there. So somebody says, I go there and eat there because of this, okay? In 5 words or less, if you can't say that about a retailer, that retailer's in trouble. I go there because they sell this product, and this product is top of the line, and I want it. Or I go there because they're most cost effective, and they've got good lines and good products. But and so getting stuck in the middle, we'll talk more about that. Number 4, the macro storm. Everything hits at once. Cumulative inflation, squeezing to the lower income customer, high interest rates, making that debt more expensive to refinance, tariffs, high fuel prices have really, they hurt everything. Freight costs, they hurt restaurants, really hurt the restaurants because they have to have food delivered at least once a week. Many of them have twice a week because food does, go bad. And so when we ran the pizza, my family ran the pizza stores. They had 2 deliveries a week, so they always had fresh food. So and they had to pay the fuel cost because of the rise in fuel. So there are a lot of things. If you've overbuilt, you put yourself in a situation where you're carrying a heavy load because you overbuilt the facility, you overbuilt the bricks and mortar side of the business. So a lot of things, we call it the macro storm. That's not the micro, the macro. That's where everything hits. You got inflation, you got rising fuel costs, you got rising energy costs, you got inflation. You hire employee salaries because of inflation. You just go on and on and on, and all of that hits, and that can drive a company that is over leveraged, has too many locations, has overexpanded. It can drive them into bankruptcy and into closure. And then killer number 5. There's no reason for you to buy anything at that store. Now, we talked about that last week. The things that have done well are things that we need. And I said, you have to have healthcare. You can't go into a hospital online. You can't go sleep in a hotel online. You've got to actually go to the hotel and rent the room and pay for it. So businesses that are required and that we need and that we have to have seem to do well. Now, this is what's hurting the Walgreens. We have to have medicine. We can go to the pharmacy and get the medicine. And, we can even buy it online through some of the pharmacies if you've got the script. But everything else in that store, pretty much you can buy online. You do not need to go to Walgreens or CVS to buy anything else. It's all online. You can buy it all. So, we talked about that last week. So no reason to visit. So if there's no reason for you to go there, and there's a chain that a store that's got brick and mortar and they've got products, but there's no reason for you to go there because you can get it easily online and it's cheaper. That business is probably going to die. It's probably going to die, and it's not going to survive. So that's the kind of thing that we need to look at. So we're seeing a change, a huge change. All the big box stores that were successful in the past are struggling. You know, I went to one of the electronic stores. I don't even want to put a curse on them. I went in there the other day, and I noticed they just didn't have much on the shelves anymore. I mean, it's changed because so many of the things that I would go there to buy, I can just get it from Amazon, or I can order it from Walmart and they'll ship it, or you can get it online. You don't have to go to the store anymore. And if you don't have to go and you can get it overnight, and what Amazon has done is they're killing everything because you can get it the same day. You order it that morning, they deliver it that afternoon. I mean, it's incredible what's happening. So we're going through some changes. I recently watched something where Warren Buffett was talking about the fact that, you know, at the end of the day, there are only about two retailers that are going to survive, and you know, Walmart and possibly Target. And the reasons is that they have built the ability to provide these products and through their stores. They're basically order filling stores, and they have engineered the cost so low to put these products to the customers that they will survive. They will survive. And people still do like to go to the store and buy their fruit. And while they're there, they'll pick up a lot of things. They like to buy their meat. You can't get that online. I guess you could, but you know, they like to go look at it and hold it. And you know, when I'm buying steaks, I want to look at them and say, oh, I like the way that one looks, and it's got the right amount of fat on it, and it's got the right thickness, and I'm going to get that ribeye or that, you know, whatever, sirloin. But there are reasons that we will go to those stores, okay? There are reasons why we go there. And again, if there's no reason to go there, that store, and you can get everything they got online, and you know what size you wear, and you don't have to go try it on, then why do you go? You know, those are the stores that are going to struggle in the future. So you can kind of analyze that, and you can kind of look at those stores and think, now, how long are they going to be able to keep that going? You know, I look at some of these stores. I'll go to the mall and some of these places, and I see there's nobody in there. And I'm thinking, what are they paying a square foot for that rent? And look at all that inventory that they've got in there. And how much product do they have to move on a given day to be able to make it? You know, I always ask that about donut shops and ice cream shops and you know, places where the product, you go in and the product is $1 or $2 or $2.50. And how many 250 sales have you got to make in a day to be able to pay the rent in those retail locations? I mean, you got to make a lot. And so is it worth it, the amount of work that you have to put into it? I mean, you know, I guess you get donuts online, but I think and you could get your ice cream, you know, but I don't know that you can get an ice cream cone online. I think you probably have to go there and get it. So, you know, with rent goes up and expenses go up, you know, ice cream cones are going to go up. I mean, it's just the nature of things. So anyways, let's look at the kind of the winners here with Walmart. You know, Walmart's probably the cleanest case study in American business today. You know, holiday quarter sales are up nearly 6%. They beat their earnings. They beat their revenue. E-commerce is growing in double digits again. You know, Walmart, they deliver the groceries now, and a lot of people don't even go. My mother-in-law, she buys everything online from Walmart, and they just bring it to her house, and she never goes to the store. She doesn't need to. Gets everything. She's not always happy with some of the brands they bring, and sometimes they miss some things, but overall, she's fairly happy with it because she doesn't have to go there. So Walmart continues to beat earnings. You know, again, they joined the $1 trillion market cap club recently. They're a 60-year-old company, discount retailer from Bentonville, Arkansas, and now they're worth $1 trillion. That's pretty amazing, huh? Pretty amazing that Sam Walton did to be able to create that. And then, of course, Sam's Club. You go there and it's always packed out. People buying stuff like crazy. And my understanding is there's very little margin, if any, on those products. And most of the money that Sam's Club makes comes from the membership. That's what I was told. And that was kind of what he started with was to build a membership, and then you would people would pay, and they could go over there and buy things. And of course, when you buy something, you're buying a lot of it because they have it packed a dozen or a case or whatnot. So you have to be careful when you go in there. You end up spending a lot of money. But looking at Walmart, they turned the biggest liability into their biggest weapon. 4,600 stores. Now, that costs a lot of money. That's their biggest liability. But, those could have been an anchor, right? They could have been dragging them down, but Walmart turned them all of those into mini fulfillment centers. Many fulfillment centers. A store within 10 miles of 90% of all Americans. And that means the same day pickup. It means delivery. And Amazon struggles to match that. I mean, they do. They have warehouses are not that close to everybody. And you got 90% of the population is within 10 miles. And, I see the Amazon guys coming up and down our street, and one will come down and he'll deliver, hit our house or hit 3 or 4 other houses on the street. And then an hour later, here comes another one. And an hour later, here comes another one. And they're just going around the clock, up and down the streets, going all the time. And I guess it makes sense. They're dropping off items. Sometimes they didn't cost but $3 or $4. But they're stopping and they're dropping them off. So I guess at the end of the day, it all works because they're moving such volume. But Walmart is doing something that I think is very interesting. They're winning the rich people. I'm talking people that have plenty of money are now going to Walmart. And they didn't used to because they thought, well, I don't want to be seen in Walmart, right? I'm upscale and I got plenty of money and I'm going to buy my stuff over here at H-E-B or some premium place, right? Well, now they're actually going in. So Walmart is winning the rich people. Their gains, market share gains, are really across all income levels now, not just the lower income people, but the largest gains are among, believe it or not, the upper household income. So that's what's happening. And what's driving that is not necessarily the prices, but it's the speed and the convenience. Those mini fulfillment centers, that's what's driving it. They just erase that stigma of being at Walmart, So when deliveries show up in 2 hours, nobody cares whether it came from Walmart or it came from Whole Foods or, one of the more expensive places. So in a way, what Walmart has done is they've copied Amazon's model, right? They've copied it, and the third, what would be called the third party marketplace, and that's that delivery that every 2 hours you get your groceries. In 2 hours you get whatever you order. I don't care what it is. You could order bed sheets and they'll be there within 2 hours. You can order a mattress. You can order dog food. I mean, it's coming and it'll be there. So that's they are driving people to them through service and the efficiency of the time and being able to make it happen. Now, let's talk a moment about Amazon. Amazon's their entire retail sector's earnings upgrades are being upgraded right now. There's a lot of momentum in Amazon's business. People are learning how the Prime. Everybody belongs to Prime. My son was ordering something off of Amazon, and I said, "You might want to use my Prime account." And he said, "Daddy, I got Prime." So here I got my son. He's still in college, and he's a Prime user. So people, the whole Amazon thing is and I think Amazon has huge volume, but they're running on probably razor thin margins. I don't think their margins are necessarily that high because I was looking at some of the products that I was buying at the drugstore that I'm now buying on Amazon and just little things like eye drops and whatnot, and they're like $2 cheaper or $3 cheaper for the eye drops than they have them at Walgreens. So and they deliver them the same day. I mean, you order it that morning and it'll be at your house that afternoon, so you don't even have to drive to the store to get it, and so it makes a lot of sense. But I think Amazon will be able to hold the prices down because of the volume, and they're going to keep getting faster and faster on the delivery. I mean, they didn't used to be same day. They started, it was overnight or 2 days or 3 days, but now many, and I guess it's because all the different warehouses are carrying all these products now, and they're able to get the product to you from the nearest warehouse. And I'll tell you, when you drive by and look at those Amazon warehouses, they're absolutely humongous. And I heard somebody say that when they work there, they walk 5 to 10 miles a night just walking through the plant doing the work that they have to do. But I think they're going to keep bleeding their competitors into the future, and that's kind of what Warren Buffett said. They're going to keep bleeding. I mean, it's going to continue to take bites out of those brick and mortar retailers, and so we're going to see that and continue. I don't think there's going to be any changes in that. It's just going to keep on keeping on. Now, Target is a little bit different story. They're more of a Target's more of a comeback story. Target went through some tough times. Y'all remember Kmart? I mean, I grew up going to Kmart, and I couldn't believe Kmart went out of business. And I noticed something about Kmart. I noticed that it took too long to check out, and they were struggling with the whole digital age, trying to get that implemented. And I think they did some financial things because they bought some other companies and different things. But anyways, they ended up going away, and now you've got Target and Walmart and then Amazon, which are going to be your three biggest. And so, but Target is a little bit different because they struggled where Walmart did not struggle. For a couple of years, they were in a slump, and they were fighting to win back the brand loyalty during that slump. And most of you remember that. I remember the slump they were in. They had to convince Wall Street that they still had what it takes to build a business. But now when you look at their most recent quarter, and I looked that up, their earnings were $1.71 per share against expectations were $1.46. So their revenue, it was 25 and a half a billion, 500 billion. So 25 billion and against expectations, which were 24.6 billion. So sales were up in all 6 of their core merchandise categories, and so they raised their full year revenue outlook, and so their non-merchandise revenue, membership income, and Target Plus third-party marketplace spiked nearly 25%. So they invested in new stores and over 100 remodels while competitors were liquidating. They remodeled, and the store that is closest to us, Target, is a very, very nice store. Remodeled. One of the things I always like, I think their carts are nice, the stores are clean, the people are courteous. They help you get through the self-pay area. They have people waiting there for you that help you get through and kind of speed that up so you don't have to wait in line a long time. So, I'm really impressed with what they've done. But Target, proves that the line between winners and losers isn't necessarily destiny, it's decisions. They were slipping toward the middle. And remember, that middle is where you die. You don't want to be in the middle. They were slipping towards it, but they fought their way out of it. And they got out of the middle. You don't want to be in the middle, folks. You got to have something up here happening or something down here happening that makes people go. But if you get caught in that middle, that's where businesses die. So a few lessons for the entrepreneur here. I think the five lessons from the great retail asset that I mentioned. These apply, really only if you're running a retail chain or a nation. It can be a network of healthcare clinics. It could be some other kind of shop. But remember, debt kills more companies than competition does. Lesson 2, scale only matters if scale is the right thing. In other words, you don't want to overgrow, build too many things, and then get caught in the middle, and then you end up dying. Or you have that macro attack where everything hits at one time, and you just can't carry the load. The inflation, the energy cost, and the cost of employees going up, and all of these things coming down at one time. So you don't want to get caught there. You don't want to get stuck in the middle. That's lesson number 3. Scale only matters if scale is the right thing. And apparently for Walmart, scale was the right thing because they built within 90% of the people in America live within 10 miles. And so they built the many fulfillment centers. So they reduced the cost of providing it and getting it there. And the way that they engineered their cost to provide those products to you was so cost effective that they were able to offer the lower prices. And now they're able to deliver to you within 2 hours anything that you order. I mean, it's just incredible. So remember, fixed assets are either weapons or anchors. Too many, overpay puts a loaded gun to you. And if revenues are softened and things change and markets change, you can go under very quick. So when you look at the the success of Walmart, Amazon, and Target, you've got stacked advertising. You've got memberships on top of their core business. You've got high margin revenue that compounds, and they've engineered themselves to where they can provide products very cost effectively. So those are the things I wanted to cover today. And again, when we look at the number of businesses that closed in 2025, 8,000 retail stores, 8,000. And keep in mind, Wall Street is projecting another 40 to 50,000 store closures over the next 5 years. Now, last week and a couple of weeks ago, I can't remember when, but we talked about all of the restaurants that were going out of business. Again, if you're in a restaurant, you got to have something special to stay open. You can't be stuck in the middle. You can't be just like somebody else. You got to have some reason why you become a destination for that customer. Why are they going to you? Why? Now, we do know that people are going to go out to eat. They like the socialization. They're going to go out. So you got to create an environment for that. Some restaurants you go to, it's not fun. It's too loud. It's not fun to be there. Service is not that great, and the food's mediocre. Well, I can tell you, when I go and I see something like that, I can say, okay, they're closing. I don't know how much longer they're going to last, but if they don't make some changes real quick, they're not going to last. So the ones that are packed out all the time and continue to offer reasons for people to come there will continue to be successful. So those are the things I wanted to talk about today. I really appreciate you guys jumping in here with us. Remember, our sponsor is Brothers Multi-Purpose Cleaner and Degreaser, right here. Now, you can get this online at brotherscleaner.com. Now, I said something wrong, and I got to straighten it out. If you buy 3 of these, you get the 4th one free. I've been saying if you buy 4, you get 1 free. No, you buy 3 and you get 1 free. You buy 1, it's $15.95. You go online, you can buy that, it'll be shipped to you, or you can go in and you can put an order for 3 and you can get 4 of them. Now, the good news is it's multi-purpose, it'll clean anything. It's eco-friendly, it's non-toxics, no acids, no alkalines, VOC-free, earth-friendly, neutral pH, has no smell, cleans everything. It's great for people with allergies. It's a great degreaser, cleans carpet, cleans everything in your kitchen, cleans your upholstery, cleans your car inside and out. There's really nothing it won't clean. You could even wash your clothes with it. It's that good. So try it on your windows. It doesn't streak. It's better than Windex, I promise you. So listen, y'all have a great day. Thank you for being part of this show today and watching. And I do want to say to you, hit the subscribe button. We appreciate it. We'd love to have more subscribers, and we do appreciate your view, and you have a blessed day. And please watch us next week. Scrushy on Business. I'm Richard Scrushy, and you have a great day, great week. Thank you.